Hello everybody, and welcome to my now usual Friday evening video where I update the valuations on my most favorite metric, which is enterprise value over trailing 12-month gross profit over revenue growth. So this is a metric where I ask the question, how much am I paying for each percentage of forward revenue growth? And I estimate that a stock is going to be undervalued when I pay way less than my average portfolio. This stock is my whole portfolio aside from Etsy and Fiverr, which has just added recently to the watch list. But you can see that the average ratio is a 0.55 for each percent of growth over the next 4 quarters. And so if a stock is under this 0.55, I estimate it's rather undervalued in my framework. If it's well over, I estimate you're paying too much for that growth. You're really paying up for that growth. And so the goal of the spreadsheet is to really figure out which stock I should maybe focus more of my buying power on right now and which stock I should trim. So let me just get started with the list. And feel free to pause if you want to look at, which stock I find cheap right now in my coverage universe. But these are the stocks that I find extremely cheap in my coverage universe, beginning by StoneCo. StoneCo is the Square of Latin America, the payment side, Payment Square. They have a little bit of an ERP system, and they are trading so cheap. It's not. I mean, I don't understand. I don't understand why it's so cheap. Then we have HIMS. HIMS is kind of the same story. Why is HIMS so cheap for that growth? It's way less valued, say, than Teladoc, for example, and Teladoc is seeing insanely slowing growth, almost no growth. HIMS is still growing extremely fast, and it's heavily undervalued in my view. Then we have C Limited. C Limited is a new one this week. I added C Limited to my coverage universe, and I actually own C Limited, so it made sense to add it to the spreadsheet. C Limited is dirt cheap. It's dirt cheap. They've come into trouble with their video game segment because their main video game, Free Fire, got banned in India, and because of that, the market put C Limited, in the dumpster, even though it's really a leading corporation with a great fintech attached to it, in addition to Shopee, which is the leading e-commerce website in Indonesia. What else do I have? I had another stock to my spreadsheet this week, which is Figs. So Figs is a stock that is on my watch list that I actually have started buying. So I actually own a little bit of Figs now, but I'm not going heavy in Figs because I am waiting for their report, for their annual report for their full year 2022 report. Figs is obviously a field that is a little different, but I think it's an interesting company. And by the way, Figs is part of a lifestyle company, so I've put Celsius Holdings and Figs in those lifestyle stocks, which are kind of a new stocks I included in the spreadsheet today. Then we have Pubmatic. I have owned Pubmatic for a long time, but it's a very small position because it's the smallest cap in my framework. But I believe Pubmatic is dirt cheap right now. SOFI and Nubank, I believe one of the big megatrends right now is the brick and mortar consumer banks around the world are getting disintermediated and they're getting disrupted. The consumer facing component is getting disrupted, not the investment banking component, but the consumer facing component is getting disrupted and replaced by apps. Quite simply replaced by apps. And I own both SOFI and Nubank. I wouldn't know which one to choose. They're both equally as cheap. But I'm actually own more of SOFI. And the reason for that is because I'm actually a little bit of a SOFI customer. I use a few of their services. And, I understand the US market. I don't understand as well Latin America. And thus, it makes sense to kind of adjust the portfolio for what I understand more, which is SOFI. And then the last one, always in the ranking, almost always, is MercadoLibre. I have very, very high conviction on MercadoLibre. They reported an outstanding full year 2022, outstanding revenue growth numbers, and their fintech division is doing so well. So I'm very, very bullish on MercadoLibre. And these are the stocks that I've been buying more recently because my spreadsheet, my method here is telling me that they're rather undervalued right now. They're cheaper than other stocks I look at. Now you may ask, and this is new to the spreadsheet, what is the most undervalued right now and what I'm doing? So the stocks that I find the most undervalued right now are number one, Nvidia. Nvidia reported slowing growth, slowing revenues. I wasn't really compelled with a report of Nvidia. But you see, for Nvidia, I'm just trimming. I'm not selling out completely because I understand the long-term thesis, and I believe most investors in Nvidia are right that these A100 chips, these $10,000 chips, are selling by the dozens. Like it's absolutely amazing, and Nvidia is absolutely powering AI. It's absolutely true that you need 5 GPUs or 10 GPUs per server rack when you only need 1 or 2 CPUs. So I understand why the valuation of Nvidia is so high. But nonetheless, even though I believe in the company in the very long run, I believe right now it's a little overvalued right now because of AI hype, because everybody's talking about AI. Everybody seems to agree that AI is the future right now, and so the stock, I believe, is a little valued. So I've been trimming Shopify. I keep trimming Shopify, and then there's Etsy, and so I don't own Etsy. I see the value of platforms in general. I don't own it. It's on my watch list. I still have to cover it on the channel. I will make a video on Etsy soon. I'll make one soon. So now what I do is I will go through each of these groupings that I have here, and I will comment on each stock in each of these groupings. So hopefully you find this interesting. So let me start with grouping 101, which is Tesla and Enphase. These are my energy revolution stocks. I believe we are going on a transition towards electric, not because electric is green per se, but because electric is a better technology. You waste way less when you do electric compared to natural gas or any type of fossil fuel. You have way less waste. It's a much more efficient technology. And right now, in the energy revolution stocks that I look at, I believe Enphase is the better buy right now, even though Tesla is cheap. Tesla is still cheap compared to the potential of Tesla and the total addressable market. So I am buying Enphase more than Tesla right now, although I've been accumulating Tesla as well because we have March 1st. Investor Day on March 1st, and so who knows what's going to happen after that. The stock may go up, the stock may go down, but I'd rather accumulate a little more Tesla. So I've been touching both, but more Enphase than Tesla right now. I think Enphase is the better buy. Moving on to HIMS and Teladoc. I am actively trimming Teladoc. I am disappointed by the growth of Teladoc. I've made a video about this a few days ago where I said, I'm just not happy with the growth of Teladoc. I don't think Teladoc is growing as fast as they should. And HIMS very, very report on Monday. So I'm looking forward to Monday. I've been adding some more to HIMS, even though it looks expensive relative to what you were buying HIMS 3 months ago. When I look at my metrics, I still think HIMS is dirt cheap. HIMS is likely a $20 to $30 stock. Right? It's not an under $10 stock. I don't understand why this stock is trading so cheap. It has all of the hallmarks of a SaaS stock, except it's not a SaaS company. It's a preventative healthcare company. I think HIMS is a wonderful business model innovation. I'm very happy to own HIMS. I've done quite a few, maybe too many videos on HIMS on this channel. So this channel likes HIMS very much. Moving on. Data warehouses, data monitoring, data stocks in general. So what was one of the bigger disappointments? By the way, that's a mistake. That should have been a yes here. Palantir reported. Well, the big disappointment there has been Palantir. I think Palantir's the growth is just not picking up as fast as a lot of Palantir bulls, which I am still a Palantir bull. I still own that company. But when is that big growth going to happen at Palantir? When is the adoption of Foundry going to happen? Right? It doesn't seem like it's going to be 2023 or 2024. Is it 2027, 2028? Well, if so, that's kind of dead money, There are stocks whose adoption is going in full swing. I buy Datadog on a regular basis. You may know this if you follow the channel. I love Datadog. What I've been buying more heavily, though, recently was MongoDB and Snowflake. I believe right now we are in the era of the data warehouse. I believe especially Snowflake is getting adopted at really impressive rates, and I've been buying more Snowflakes because even though Snowflakes may look expensive right now, if you compare Snowflake to videos I was making about a month ago, the same most undervalued video, you'll see that Snowflake actually went down quite a bit in valuation. So I'm very happy about that, and they haven't reported yet. I look forward to them reporting and see. And I also like that Snowflake has already guided for 49% growth in 2023. They've already provided that guidance, which is amazing guidance to find a company who actually goes out and says we're going to do 50% growth. 49, but you get what I mean. It's amazing. It's amazing. So I think Snowflake over the long run has a tremendous potential over the long run to be the layer one or the AWS of data infrastructure, and that's what they call themselves, right? The data cloud. I think their marketing is very, very clever. A lot of companies, a lot of CIOs that are not necessarily data engineers or data scientists understand Snowflake's value proposition. I believe they have a harder time understanding Palantir's proposition. So we'll see what to do with, but I've been adding more to Snowflake. Moving on, and by the way, I'm considering trimming a little bit of Palantir. By the way, I haven't done it yet, but I'm considering trimming a little bit of Palantir. Moving on to cybersecurity stocks. Cybersecurity stocks, there's a lot to discuss actually. The stock I've been buying right now is CrowdStrike. And I haven't been adding to Zscaler, and I have not been adding to Cloudflare, because when I listen to the conference call of Cloudflare, I am growing more and more fearful and concerned about Zscaler, because if you look at some of the data that has been published by Cloudflare, their zero trust solution seems to be very, very, very highly performing. So I am a little concerned about the competition between those two. And especially the competitive position of Zscaler. So I am been adding Zscaler, and I'm waiting for their annual report to decide whether I should add Zscaler or not. Regardless, it really doesn't matter because CrowdStrike is clearly the cheapest. And so I have been adding to CrowdStrike. All right, let me move on. So we have MercadoLibre, C Limited, and Shopify. What I have been doing here is that Shopify is clearly expensive. I have been trimming Shopify. I have been reducing my position in Shopify, and I have been adding it to MercadoLibre, including today. The stock barely moved. Like, they had an amazing quarter yesterday, and the stock barely moved. It's to tell you how much the market only cares about inflation prints for the next month. That's literally the market movements right now. So trimming Shopify, adding to MercadoLibre. I am considering adding to C Limited, but I want to wait until their quarterly report. And I really want to wait for C Limited what that video game division is doing, because they've been hurt. They've been hurt by that ban. And I don't know video games enough. Like, I don't know the state of their game Free Fire. I don't know how strong of a state it is, and it's kind of problematic that in your numbers you have about a third of the business that's video games. It's great. It's a mega trend. I'm glad to be in this mega trend, but it makes the analysis of a company like C Limited a little more complicated. And the direct comparison between MercadoLibre and C Limited stops with the fact that they also have a gaming division. MercadoLibre has e-commerce, has fintech. SC has e-commerce, fintech, and gaming, which I think kind of makes it more complicated. Shopify, like I said, I've been trimming. Shopify is expensive right now. A lot of the market agrees with me on Shopify, and thus they've bid up the stock. Let me move on. Payments. There is a clear winner here to me, and it is StoneCo, i.e. the Square payment terminals of Brazil. The stock is still down. The market still has not noticed StoneCo. I believe StoneCo is down so much. Well, I know it's down so much because of their collateral issue. They had a major collateral issue with credit loans and posting a bunch of credit losses. That was more than a year ago. They've solved the issue, but the market still hasn't forgiven them, and the market still hasn't given back the valuation that they used to have, right? So I've been buying StoneCo. I haven't been touching DLocal and Square. If you follow my channel, you know that DLocal is under attack from a short report, and I'm waiting to see what they're going to say on the next conference call. It seems like DLocal has confidence in itself. It's in the payment space. They've done a little bit of buyback program, but and DLocal, quite frankly, is a much smaller position for me than StoneCo. So I mean, even if it goes down, it's not going to impact me as much. StoneCo, it's been getting really, really cheap. It's been hovering around that $10 mark for like a year, and it's like this stock is entirely ignored. So I'm accumulating slowly but surely. Moving on, chip makers. So chip makers, I am almost completely sold out of Nvidia. I'm essentially sold out. I have a little bit left, I think, in an IRA somewhere, but that's it. I'm sold out. Let's just call it like that. I'm sold out of Nvidia. I think I have just one IRA, an old IRA where I have a little bit of it. But my main portfolio, I'm sold out of Nvidia, and the reason for that is because I believe it's way too expensive right now. It's the hype. Like I said, I'm not adding to AMD either. By the way, I was adding to AMD a few weeks ago, but I'm not adding to AMD either because I think AMD is also a little expensive, and AMD has obviously a smaller potential than Nvidia. I believe, but over the long term, I don't want to undermine the fact that I want to get back into Nvidia. I believe I still own that company, like I said, in one IRA. I don't want to get I don't want to be out of Nvidia over a very, very, very long run. But right now it's overshot to the upside. It's really a little too expensive. I believe you're paying up for that growth, especially because their growth is down. Moving on to Pubmatic versus the Trade Desk. I've owned the Trade Desk for a while actually. It's a fine position. It's a fine stock. The ad tech business is kind of in trouble. I've added just a teeny tiny bit, not even worth mentioning. I've added a little teeny tiny bit to Pubmatic because Pubmatic is still extremely dirt cheap. But the company I've been adding in ad tech and recently more heavily is Google. So Google I know does not fit the profile of a high growth stock, but as soon as advertising resumes, I believe Google will win. Moving on to my lifestyle stock. So this is my new category in there. So Celsius. Celsius looks cheap here because that is, I have put them at a 96% revenue growth, which is what analysts say it's going to be. I'm waiting to hear the conference call and see what they say. Are they really going to double sales over the next 4 quarters? And if they do, then you're not paying up that much for that growth. Celsius, had it for a while. I don't follow it. I don't follow it too much. I don't follow the day-to-day on Celsius, but I do drink it. I think it's a good product. And figs. So I've covered figs. Figs, actually, I have started accumulating a little bit, and I am waiting to accumulate a little bit more of figs, and I'm waiting for their next quarter and for the next quarterly report and see what's going on. All right. Nubank and SoFi, I own them both. You're pretty much paying the same price for growth whether you buy Nubank or SoFi. And I own them both. I own more of SoFi than Nubank. I haven't done too many changes on that part of the portfolio. The last one is my platform. So I don't own Etsy, I don't own Fiverr, but I own Airbnb. Airbnb has been running up, and I haven't added to Airbnb. I think Airbnb is doing great. I think the market for Airbnb is going to be much bigger than most people assume, and it's a great stock to own. And it is one of the cheapest stocks in the platform space, along with Fiverr, which I do not own, but significantly cheaper than my average. So, anyways, I hope that gives you a little bit of insight into mostly what my portfolio looks like, and I cover the stocks that I own on this channel, or the stocks that I'm interested in owning. So this gives you a good picture into how I'm thinking about these stocks. And my strategy is always about trimming a little bit those who are overvalued and adding a little bit to those who are undervalued, and generating alpha by dealing with stocks as pairs, right? When you look at a pair of stock, for example, I'm selling a little bit of Teladoc and I'm adding it into IMS. And if one day IMS were to become so overvalued and Teladoc is a different story, but you know what I mean. If Teladoc were to resume growth, then it would make sense maybe to sell the overvalued, to buy the undervalued. But you don't do it on the whole stock. You do it only on a smaller portion of the company. And that's how I've done it for many, 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 many years now. So Hopefully you enjoyed this video. Thank you for watching. None of this was investment advice. This is just entertainment, no investment advice. Please like, please subscribe. Appreciate any like I can get. Thank you very much and have a wonderful day. Thank you.